Every single dollar you invest while simultaneously carrying a credit card balance represents a guaranteed net loss, not a potential loss, not a calculated risk, a mathematical certainty you can verify with a pocket calculator. The stock market has averaged roughly 10% annually over its long history. The average credit card in America right now charges 21% interest, with cards actively accruing interest running at 21.5% according to Federal Reserve data. You are losing 11.5 percentage points before the market even opens on Monday morning. And the entire financial media apparatus is standing on the sideline, enthusiastically applauding your decision to do exactly that. Here is what makes the situation considerably worse. The advice itself is not technically wrong. It is simply missing a critical condition. And that missing condition applies directly to the majority of people living in America today. I am going to show you precisely who the invest early advice actually serves well, who it quietly and systematically destroys, and what you should genuinely be doing instead based on your actual situation. I am going to walk you through a 3-level framework that the wealth management world uses internally among professionals, but almost never explains clearly to the person sitting across the desk from them. And by the time this is finished, the next time someone confidently informs you that compound interest is the 8th wonder of the world, you will know exactly which question to ask them in return. Which direction is it compounding? Think of the whole situation like a leaky bucket. You can pour money in from the top continuously throughout the day. The bucket can be expertly positioned, perfectly calibrated for your stated risk tolerance, diversified across multiple asset classes, managed by a credentialed professional. But if there are holes in the bottom, and for most Americans there are genuinely serious structural holes draining the bucket constantly, the water escapes faster than you can possibly pour it in from above. The entire invest early conversation is focused exclusively on pouring faster. It has absolutely nothing useful to say about the holes themselves. That is the leaky bucket. We are going to return to it shortly. I am going to show you something genuinely uncomfortable about what actually happens to working Americans when their real financial lives collide with the actual rules governing a 401k. But first, let me demonstrate how fundamentally broken the underlying mathematics is for the majority of people currently following this popular advice. The average American credit card balance as of the fourth quarter of 2025 was $6,715 according to TransUnion data. Generation X carried the highest average credit card debt in 2025 at $9,600, followed closely by millennials at $6,961. The primary audience consuming invest early advice is overwhelmingly millennials and Generation X. The people being told most loudly and most persistently to invest are precisely the people most deeply buried in the debt that makes investing a negative expected value proposition. Here is the straightforward math that nobody bothers to state directly out loud. If you have $6,700 sitting on a credit card, charging 21% interest, and you are simultaneously directing $500 per month into an index fund, you are effectively borrowing money at 21% to earn 10%. A third grader armed with a basic calculator can explain how that arithmetic resolves. And yet, this is the dominant personal finance strategy being followed by tens of millions of Americans heading into 2026. Credit card balances have risen by $482 billion since the first quarter of 2021, representing a 63% increase across 5 years. That is not a willpower problem or a character deficiency. That is a strategy problem manufactured and sustained by financial advice that consistently skips over the conditions that determine whether the advice actually applies to your situation. Among people carrying credit card debt, more than 2 in 5 report that the primary cause was an emergency expense, specifically medical bills, car repairs, or unexpected home repairs. Approximately 1 in 3 cited ordinary day-to-day expenses like groceries, childcare, and monthly utilities. The overwhelming majority of this debt does not originate from extravagant spending. People are simply attempting to survive their actual lives. This distinction matters enormously because the standard response to credit card debt in mainstream financial media is fundamentally a moral one. People are undisciplined. People are spending irresponsibly. If you accept that framing, the solution becomes behavioral. Simply stop spending so much and develop more restraint. But if the debt is structural, driven by emergency costs and basic survival spending, then the solution must be architectural. You need to fix the underlying structure itself, and the first architectural fix required is not an index fund, it is the bucket. Now here is where this story takes a hard pivot. You might reasonably assume the credit card math represents the central problem being described. It is not actually the worst problem. The worst problem is what happens to a specific category of investor when the inevitable emergency finally arrives. The kind of investor who appears to be doing everything correctly on the surface. Stay with me here, because this is precisely where the compounding machine reverses direction and begins working directly against you. Nearly 1 in 4 Americans currently has no emergency savings whatsoever. According to Bankrate's 2026 Emergency Savings Report, more than 2 in 5 Americans, specifically 43%, cannot cover a $1,000 emergency expense using their available savings. According to a U.S. news survey conducted in January 2026, a blown tire, a single root canal procedure, a 3-day emergency room copayment, 43% of the entire country cannot absorb any of those without immediately going into new debt or pulling money from an investment account they were told to leave untouched. Now think carefully about what happens to those specific people if they follow the Invest Early guidance faithfully and completely. They open a 401k account. They contribute 6%, 8%, or 10% from every single paycheck. The market does its historical thing. The account balance grows steadily. They feel genuinely good about themselves and their financial choices, and they are accomplishing something real. They are constructing a retirement account that is growing. They are also simultaneously constructing a landmine buried directly beneath their feet. According to Vanguard's How America Saves report for 2026, 6% of 401k plan participants requested hardship withdrawals during 2025, establishing a new record high, up from 4.8% in 2024 and from a historical average of roughly 2% before the pandemic disrupted everything. That rate has tripled in fewer than 5 years. The pandemic conditions have long since passed. The market has fully recovered and then some. Account balances are sitting at record highs, and hardship withdrawal rates are simultaneously also at record highs. Those two facts exist side by side at the same moment. That is not coincidence. That is the leaky bucket operating exactly as the structural design predicts. When you withdraw money from a 401k before reaching age 59 and a half, you immediately owe ordinary income taxes on the entire withdrawal amount, plus an additional 10% early withdrawal penalty on top of that. You could realistically lose between 25% and 35% of the total amount you withdraw. A $20,000 withdrawal might actually deliver only $12,000 to $14,000 after the government takes its portion in taxes and penalties. Here is the complete structural picture of what this actually means in practice. You invested money you genuinely could not afford to invest because you had no emergency buffer protecting your financial foundation. When the emergency eventually arrived, the government extracted roughly 1/3 of your accumulated savings as the fee for accessing your own money ahead of their preferred schedule. You accepted full equity market risk exposure throughout the entire accumulation period. You waited patiently for the compounding to build your balance meaningfully. And then you handed 30 cents of every dollar to the IRS as the unavoidable price of living inside the actual world with its unpredictable circumstances. Your net financial position following that entire sequence is frequently worse than if you had simply kept every dollar in a high-yield savings account throughout the complete period. I want to walk you carefully through a scenario that plays out far more frequently than any financial advisor will honestly acknowledge in a client meeting. There is a person I will call Marcus. He begins investing at 26 years old, immediately after finishing college, precisely as the conventional advice recommends. He reads the recommended books. He contributes 8% of every paycheck directly into his 401k. His employer at this particular small company offers no matching contribution whatsoever, but Marcus maintains his discipline without wavering. By the time he reaches 33, he has accumulated $38,000 in that retirement account. His colleagues and friends are genuinely impressed by his financial progress. Here's what Marcus also has sitting in the background of his financial life: $9,000 in credit card debt, charging 22% interest that he has been making minimum payments against for 4 consecutive years. Zero emergency savings because he has been directing every available dollar into investing instead. A job at a company operating on thin profit margins with significant exposure to supply chain disruptions affecting their business. The layoff arrives in January. He receives 8 weeks of severance pay to bridge the gap. He interviews effectively and secures a new position within 14 weeks, but the intervening period is genuinely brutal. Rent payments, car payments, grocery bills. The credit card minimums he could barely manage during stable employment months, all of it pressing against his rapidly depleting severance. The severance check runs out completely at week 8. Marcus taps his 401k account. He withdraws $30,000 from the account. Federal income tax at his applicable bracket, plus state income tax plus the 10% early withdrawal penalty, reduce that amount dramatically. He ultimately receives approximately $20,000 in usable cash. His remaining account balance, $8,000. At 33 years old, following 7 consecutive years of disciplined and consistent investing, Marcus has $8,000 remaining in his retirement account and $9,000 in outstanding credit card debt. His net investable position is negative $1,000, and the credit card balance had actually grown throughout the period when he was making only minimum payments because the interest was compounding against him faster than his payments were reducing the principal. At average balance and average APR levels, it requires more than 7 years of minimum payments to fully clear a credit card balance, costing roughly $3,610 in cumulative interest charges alone. That is the reverse compounding machine running in the background throughout the entire period. Marcus believed he was actively building wealth for his future. This outcome is not a failure of personal discipline. Marcus demonstrated more consistent discipline than most people manage to sustain. This is the direct consequence of applying Level 3 advice to a Level 1 financial situation. Which brings me directly to the framework itself. By the way, if this content is connecting with you, hit subscribe right now. The algorithm has a notoriously short memory and may genuinely never surface this content to your feed again without that signal. The financial world that manages institutional capital, family office assets, and high net worth advisory relationships operates according to a carefully ordered sequential framework. They consistently hand most regular people only the final conclusion of that framework without ever explaining the prerequisite conditions that must be satisfied first. Here is the actual complete sequence as it actually operates. Level 1 is foundation. No emergency fund established. High interest consumer debt outstanding. Specifically, anything charging above roughly 7% to 8% annually. This is where the majority of Americans genuinely reside financially. The mathematically correct action at Level 1 is to build a starter emergency buffer of $1,000 to $2,000 first, just enough to absorb the most common financial emergencies without creating new debt, and then direct every available dollar at your highest interest debt aggressively. Not invest. Eliminate the highest cost holes in the bucket before anything else. The effective return on paying off a 22% credit card balance is 22%, guaranteed, risk-free, and effectively tax-free in practical terms. No index fund in the entire history of index fund investing reliably and consistently delivers that kind of return. Level 2 is stability. You have eliminated the toxic high-interest debt. You have built a genuine emergency fund covering 3 to 6 months of your actual living expenses. Now the mathematical landscape shifts meaningfully. If your employer offers a 401k matching contribution, you capture that match at this stage of the journey. A 50% to 100%. Instantaneous return on matched dollars belongs in an entirely different mathematical category from ordinary market investing. You also begin addressing moderate interest obligations like federal student loans at 6% interest. You are constructing a stable platform at this level, not assembling an investment portfolio. Level 3 is acceleration. No remaining consumer debt. A real and adequate emergency cushion fully funded. Employer match captured completely. Now you invest broadly, systematically, early in your career, aggressively, and with genuine long-term patience. Now the invest early advice functions exactly as described and promised. Now the compounding machine has no structural holes bleeding value out the bottom. Every dollar you direct into the market stays in the market working for you. The fundamental problem within the financial industry is not that level 3 advice is incorrect or misguided. The problem is that industry professionals deliver level 3 advice to people firmly situated at level 1 and charge them a management fee for the privilege of receiving it. The long-term average annual return of the U.S. stock market runs roughly 10% based on S&P 500 historical data across extended periods. But a landmark J.P. Morgan study found that actual real-world investors averaged only a 2.9% annual return across the period studied. 2.9%. The enormous gap between what the market delivers in index form and what investors actually capture in their accounts is not primarily explained by market failure or bad fund selection. It is explained by behavioral failure. People investing money they genuinely cannot afford to leave invested, being forced to pull it out at precisely the wrong moment, paying penalties on the withdrawal, monitoring the account compulsively under stress, and selling index fund positions at the absolute bottom of corrections. The advice universally assumes a perfectly rational, perfectly stable human being operating under ideal conditions. Most actual humans are neither perfectly rational nor perfectly stable, especially when their financial security feels genuinely threatened. Now here's the element that should generate genuine, analytical frustration in you. Not conspiratorial anger necessarily, but quiet and clear-eyed annoyance at a structural reality. A full third of all American financial assets are currently held inside retirement plan accounts. As of September 2024, those accounts collectively represented more than $42 trillion in accumulated wealth. Financial advisors typically charge 1% of assets under management annually for their services. 1% of $42 trillion calculates to $420 billion in annual fee revenue. The advisor's business model is structurally rewarded for growing the pile of assets they manage on your behalf. Paying off your credit card balance does not grow that managed pile. Declining to invest while you systematically build an emergency fund does not grow that managed pile. Recommending that you invest even when the honest mathematics clearly says pay off the high-interest debt first is, from the perspective of their business model, entirely rational professional behavior. This is not a coordinated conspiracy requiring secret meetings. It is simply a profession whose incentive structure creates a persistent and systematic misalignment with your actual financial interests. The reason your financial advisor never laid this out clearly is that he earns compensation when you invest assets he manages. He earns nothing when you call your credit card company and pay off the balance. Let me take a deliberate pause here because I recognize the objection forming in your mind right now. What about the employer match? You acknowledged it is free money. Surely capturing that is always worth doing, regardless of your debt situation, correct? Yes, an employer match does represent a 50% to 100% instantaneous return on every matched dollar you contribute. If your employer matches 50 cents for every dollar you contribute up to 6% of your salary, that is a guaranteed 50% return before the market influences anything whatsoever. Taken in complete isolation, that return mathematically beats paying off a 22% credit card. Mathematically, in pure isolation, that calculation holds up. Here's the problem with that isolated analysis. The match only genuinely qualifies as free money if you can leave it completely undisturbed and untouched when the next emergency arrives. According to Vanguard data, 42% of hourly workers cash out their 401k account entirely when they transition between jobs. 42%. The average American changes jobs approximately 12 times across a complete career. If nearly half of every job transition for hourly workers involves a retirement account, liquidation with the full combined tax and penalty impact applied, then the employer match is not functionally free money in real practice. It is deferred money carrying an effective 30% extraction fee attached and waiting to be triggered the next time a genuine financial emergency materializes. The 50% gain generated by the employer match gets consumed by the 30% exit tax applied at the moment of withdrawal. You net approximately 20% over a sufficiently short time window, which is less than you would have earned by aggressively eliminating a 22% interest rate card across that identical period. The employer match belongs conceptually in level 2 of the framework, not level 1. Contribute enough to capture the complete match after you have your $1,000 to $2,000 emergency buffer established, not before that foundation exists. Here is the student loan dimension that the majority of people are not calculating accurately either. The average federal student loan balance per borrower stood at $39,633 as of December 2025, according to Department of Education data representing a record high. The average interest rate on federal undergraduate direct loans for the 2024 to 2025 academic year was 6.53%, 6.5%. Meaningfully lower than credit card rates, but here's the mathematical step that people consistently skip when evaluating this trade-off. If your real behaviorally adjusted actual investment return as a typical individual investor runs closer to the 2.9% figure from JP Morgan research, then you are likely losing ground in real economic terms by directing money toward investing instead of paying down a 6.5% student loan. Not theoretically or in some abstract scenario. Actually, in practice, with real money, because the model's underlying assumptions fail to match the human behavioral reality of how most people actually manage their investments over time. Americans aged 50 to 61 carry the highest average federal student loan debt of any age group at $46,556 per borrower. These are individuals approaching retirement in what should be a capital preservation and consolidation phase, still carrying education debt accumulated 2 or more decades ago. They have been investing alongside that debt throughout, precisely as advised by every source they consulted. The advice never ran the honest and complete mathematics for them at any point along the journey. This is the moment in these conversations when someone reliably suggests something along the lines of, surely you need to do both simultaneously, split the difference, find a middle ground. I understand that instinct completely. It feels like reasonable balance and moderation. The problem is that financial mathematics is not symmetric in its structure and logic. A guaranteed 22% loss is not meaningfully offset by an expected 10% gain. You do not balance those two forces against each other. You eliminate the 22% drain first, completely because it is categorically and substantially larger than the expected gain. There is a well-known story about a senior executive at a major financial institution who was asked by a journalist why his firm's wealth management division consistently recommended investing over debt elimination for middle-income clients, despite the clear mathematical advantage of prioritizing high-rate debt payoff. His response, paraphrased for accuracy, was approximately this: "Our clients pay us to help them grow their asset base, not to help them reduce their liability side." Those are fundamentally different services. He was not factually wrong in that statement. He was simply describing a profound conflict of interest in the calmest and most matter-of-fact possible language available to him. Now I want to address the dimension of this problem that nobody in financial media frames as a financial issue, but which is almost certainly the deepest and most fundamental driver of the persistent gap between professional advice and real-world outcomes. You believe the core problem is mathematical in nature. The actual core problem is psychological, and the mathematics are downstream of the psychology, not the other way around. There is a thoroughly documented phenomenon in behavioral economics research called the bandwidth tax. When individuals exist under chronic financial stress, genuinely uncertain about making rent this month, covering an unexpected car repair, keeping essential utilities connected, their available cognitive resources are partially consumed and occupied by that persistent underlying stress. The mental bandwidth remaining for long-term planning, complex multivariable reasoning, and impulse regulation is measurably and significantly reduced as a direct result. Financial scarcity, completely independent of educational background or raw intelligence level, demonstrably impairs the quality of financial decision-making in affected individuals. This is not a character flaw or moral failing. It is a cognitive resource constraint, operating in predictable and documented ways. You genuinely cannot maintain patience with money you cannot realistically afford to lose. And when you invest money you cannot afford to lose because the immediate alternative, a medical bill accumulating on a 22% credit card, is genuinely catastrophic. You will react emotionally to every market correction that occurs. You will check the account balance multiple times daily, and you will sell your index fund position at the absolute bottom of the drawdown, because the psychological pressure of watching what functions as your emergency reserve simultaneously losing 20% of its value is simply too overwhelming to endure passively. More than half the American population, specifically 52%, reported worrying about their finances on a daily basis, according to a June 2025 survey conducted by Ramsey Solutions. 34% reported losing sleep regularly over financial concerns. These are not the psychological conditions under which anyone successfully builds patient, long-horizon, compounding wealth across decades. These are precisely the conditions under which people make panic-driven hardship withdrawals, cash out retirement accounts entirely when changing jobs, and sell index fund positions at the bottom of corrections, locking in permanent losses. Building a genuine emergency fund before initiating aggressive investment contributions does not merely make you mathematically more resilient to shocks. It actively restores cognitive bandwidth. It reduces the persistent anxiety tax being applied to your daily decision-making capacity. It makes you measurably and demonstrably better at every subsequent financial decision you face, including the critically important decision to hold your position steadily and stay the course through a 12% market drawdown. The foundation is not a cautious precaution you take before the real strategy begins. It is a performance-enhancing prerequisite for everything that follows it. Here is the genuinely ironic part of this entire situation, appreciated in a bleak and mildly absurdist way. The financial industry has been fully aware of this sequencing logic for decades. The correct ordering has been embedded in certified financial planner training curricula for many years. The emergency fund is supposed to come before the investment contributions begin.